How's that? It's Brendan here from Infinite Investment Solutions. Trying to bring you another property investment insight. So let's talk about the pros and cons of syndication. It starts with the word sin. It must be terrible. No, I don't believe that syndication is terrible. I believe, because I've seen it in reality, that syndication is exceptionally powerful. And why? Simply because syndication gives most people that wouldn't otherwise have access to great deals. So what do I mean by a great deal? How do we know if something's a great deal? So I look at the risk, like what's my potential to lose money in a transaction? And you know what Warren Buffett said? Warren Buffett said, rule number one is don't lose capital, and rule number two is refer to rule number one. So how do we protect ourselves? How do we protect our capital? And let's take a typical example. Let's say we're going to buy a house to rent it out for future income at some point in the distant future. When we settle the bond, hopefully we get a substantial, nice, relatively passive income. And when I say relatively passive, because if you've ever owned property, you know that it's not really passive. You still have to do some work to collect that income. So now you've got one house. Maybe you paid $100,000 or $200,000 for it. Maybe you paid R1 million or R2 million or whatever the case may be, or one apartment, and you've got one tenant. And what's the problem with that? If you've ever been in property or you've ever done anything in property, you'll know that tenants sometimes don't pay. And when they don't pay, the cash flow dries up. And the secret, the real reason we're doing all of these investments is to get cash flow, to get money in on a regular monthly cadence that can pay for our bills. You can't buy Starbucks with capital growth unless you exit the deal or unless you refinance or something like that. But we live on cash flow on a monthly basis. I've got to pay insurance. I've got to pay medical bills. I've got to pay kids' education. I've got to pay my own education, because I spent a lot of money on that too. Last year I spent probably north of $25,000 on my own education, actually paying somebody else for their mentorship and their skills. So I also spend a lot of time, a lot of money on education, and we have to pay these things on a monthly basis. Entertainment, food's gone up ridiculously. And if we have to pay this from cash flow, and we have an investment that's maybe got a mortgage bond on it, or maybe has some body corporate fees, and definitely has rates and taxes or property taxes or something like that, and the tenant doesn't pay, the cash flow's gone, means you have to find that money to pay the mortgage. You've got to find the money to pay the homeowners association fees. You've got to find the money to pay the rates and taxes. And you've got to find the money to keep feeding yourself and keep paying all those other living expenses that, cost money to live. I know everybody likes to think we can live on happiness and, all the rest of that stuff, but it costs money to live. We have to face reality. So when that cash flow dries up from that one tenant when he doesn't pay, and it does happen, if you're in it for the long term, and if you're not in real estate for the long term, you're not going to make any money. You have to be in for the long term. If you're in for the long term, you're going to have at some point a tenant that doesn't pay. And if you've got one property with one tenant and that tenant doesn't pay, you're hunting for cash. And if you don't have that cash backstop to see you through that little time period when the tenant doesn't pay, you're in a lot of trouble. All of a sudden, they're attaching the house, they're selling the house, they're potentially attaching your other personal assets if you sign personal surety for the debt. If there's a shortfall between what they sell the house for and what you owed them, you're still going to be liable for that difference. So when a tenant doesn't pay, it has very, very real consequences that people don't like admitting. When they tell me, I hate syndications, I think they're so terrible. And I'm like, well, when you have control over that one property and that one tenant doesn't pay, what then? That never happens. That's a bunch of crap. It happens all the time. In every property that you have, you will have some vacancy at some point. And I know I'm stressing this point quite dramatically over here, but it's because it's real. Between myself and my team, in the last 5-6 years, we've transacted over $500 million in the US. Our portfolio at the moment is about $154 million. under management. So we've got a little bit of experience to bring to the table that we like to share with people. It's not to brag, it's simply experience. And you know what they say about experience. My business partner Kevin loves saying this. So experience is what you wished happened to somebody else. So it's one of those things where we bring the experience to the table so that we can share with you what you need to think about in order to be successful in your own investments. Whether you invest with us or invest without us, the reason we're putting up these videos is so that we can share the knowledge and we can share as much as possible so people can avoid the pitfalls that we've had to go through. And one of the pitfalls I had to personally go through was vacancy. So bought a house in America. Tell you a quick story. We actually bought quite a few houses in America, and I sold over 400 homes in America. So I understand the complexities, and those 400 homes were investment homes. So single family houses and condos in Atlanta, Oklahoma City, Memphis, Orlando, and North Dakota. So I understand that when the vacancies happen, there are very real consequences and very dire effects to your cash flow. And not only that, when a tenant moves out and it's vacant for 6 weeks, 8 weeks, whatever it takes to get a tenant ready, all of a sudden you're not finding the money just for the bond and for the homeowner's fees and for the rates and taxes and all the rest of that stuff. You're also hunting for the money to do the refurb, to get a tenant ready so that you can place a new tenant. And let me tell you what that feels like. I had a property in Atlanta, cost me $10,000 to do a refurb, and that was cheap. That was very basic. It was paint inside, do a couple of the rooms with carpets, and paint the kitchen fittings. Maybe I got ripped off, I don't know. Maybe there's people that can get it done cheaper. I was on the other side of the planet, sitting in South Africa. I needed it to get done, so I paid some contractors, and that's it. That's the end of it. $10,000, and I've seen much worse. I've seen people with 200 square meter house, maybe a 2,000 square foot house, get bills north of $20,000 when a tenant leaves. And if you've got to get a tenant ready at $20,000, how do you think your cash flow is feeling at that particular time on that one property? It's horrendous. So let me please share with you some insights on the power of syndication. If I'm buying, let's say I bought that property with $120,000, and I take that $120,000 and I go put it in a pot with another 10 investors, and we go buy a $10 million or an $18 million building, 140 units or 180 units. If we look at the income buffer that we've got to protect ourselves against the point where we have to start funding in if we've got the right debt, and we put down a 30% deposit, that type of scenario, we need 40 to 50% of the tenants to stop paying before we have to start paying out of our back pocket. That means instead of one tenant not paying me, I can have 40 tenants not pay me, and I will still be safe. I still don't have to find any money out of my back pocket to fund any shortfalls. That is phenomenal. That means I've got 40 times less chance of losing my money. I've got 40 times less chance of being in a bad situation where I've got to go and hunt down money from somewhere else to fund an investment that's supposed to be paying me. The reason we're investing is to pay us, not to keep paying out. It's very important to understand this fundamental difference. I want a diversified income across 140 or 200 tenants, all paying me a little piece. So with my same $100,000, I could be in one house or I could be in 140. I'll take the 140 all day long. And the reason most people want to choose the single family home or the one house scenario is they want control. They want to be able to get out of a bad investment. Well, the reason you want to get out of it is because it's costing you so much money when it's vacant, because it's a bad investment. So you want that control so that you can get out of it because it's crap. Sorry to get so real, but it's true. So you don't need that control. And to be fair, whenever I've had investors or partners that want to exit a syndicated deal, usually the other partners are happy to buy them out at par value or better. So if you put in $100,000 and it's a much faster closing time, you can have your money out in a week to 2 weeks. So the other partners then step up and say, hey, the investment's still working, your life has changed, you want to get out of the deal, we're happy to continue with it, it's creating great cash flow, it's got a very low risk, we've had a a purview into it because we already own it. So we know what the performance is in reality. We don't need to rely on a broker's opinion or on any pro forma calculations where somebody's trying to bullshit us into taking on a deal that's rubbish. Those partners of yours are the best possible exit if you want to get out of a syndication deal, and it means you can get out of it quite quickly. Now, when markets are choppy and when things are going south and when things are bad and the investment's not working, then yes, it's probably difficult to get out of a syndicated environment. But if markets are choppy and it's difficult to get out of a syndicated environment, trust me, it's difficult to get out of a single family home environment as well. And you're probably going to have to take a bath on the price if markets are bad, whether you own an individual investment or a syndicated investment. So you sit with the same risk to get out, but on the syndicated side, you can get out faster because you've got a group of partners that have had a purview into it and can pay you out much quicker. And you get the diversified income. So you get a much lower risk than buying a single family home or buying a condo on your own. And you've got a group of people that will back you. And you've got commercial debt. So if I can go and get, instead of buying a house with 9.75% debt or 10% debt, whatever the case may be, which is what we can get in South Africa, and if you're a foreign buyer going into the US, you're going to get debt at 9.75 to 10%. I've seen it all the way up to 12%. Because they don't like giving foreigners easy debt, easy sort of commercial debt terms. You've got to have a US balance sheet to get the right debt terms. So if I can get debt at a much lower rate, I can have a diversified income, and I have partners that would potentially take me out of a situation when I need to get out of it if my life has changed and I'm moving overseas or I'm doing something and I need to liquidate that investment. At least I've got people there that are in the investment that have a very good incentive to take me out. And if I'm fair in my price point and I only want to get out at par value, usually the investors will be very accommodating in that regard. On top of that is most people can't access an $18 million deal on their own. So to get the lower risk, to get the benefit of the diversified income, to get the benefit of the better debt, to get the benefit of a much more sophisticated transaction, if you don't have the $5 million to put down and you don't have the balance sheet to be able to get the loan, then a syndicated environment that gives you access to that level of sophistication is phenomenal. It's a huge benefit that most people don't really acknowledge and take for granted. And I think it's really worth thinking about those types of benefits. I'm very thankful that I'm in syndicated investments. It means that I've been able to put my personal money in a $154 million portfolio that's very, very stable, has very low risk, and is producing income on a monthly basis. So because I've had access to those deals, we provide that type of access to partners all the time. And the benefit is we all get to benefit from the lower risk. We all get to benefit from the better debt. We all get to benefit from a much more liquid environment. And to me, that's a win-win-win situation. So if this made sense to you, start thinking about getting out of your single family homes, getting out of this stuff that you think you have control over. But at the end of the day, the logic just doesn't make sense. Take care and have a great day further. Bye-bye.